Welcome! Have you ever wondered how to figure out if a company's stock is a good buy? It's not just about looking at the price. Today we're going to learn a powerful technique called fundamental analysis. By the end of this video, you'll be able to understand the real value of a company, not just its stock price. You'll learn to read financial statements and use key metrics to make smarter investment decisions. Think of it this way. If you were buying a house, you wouldn't just look at the asking price. You'd check the foundation, the roof, the neighborhood, and the property taxes. You'd analyze its fundamentals. Fundamental analysis is the same idea for a company. It's the process of looking at a company's financial health, its management, its industry, and its competitive advantages to determine its true or intrinsic value. Our goal is to find companies whose intrinsic value is higher than their current stock price. This is what we call an undervalued stock, and it's where the opportunity lies. So let's get started and learn how to uncover these hidden gems. So where do we find the information we need for this analysis? The most important documents are a company's financial statements. Publicly traded companies are required to file these statements with the Securities and Exchange Commission, or SEC. You can find them on the SEC's website, EDGAR, or on the company's own investor relations page. There are three main statements we'll focus on. Think of them as three different lenses through which to view the company. First, we have the income statement. This tells us how much money a company made or lost over a period of time, usually a quarter or a year. Second is the balance sheet. This is a snapshot of what a company owns and owes at a specific point in time. It's like a financial photograph. And third is the cash flow statement. This shows us the actual cash coming in and going out of the company. It's crucial because a company can look profitable on paper, but still run out of cash. Let's start by diving into the income statement, often called the profit and loss, or P&L, statement. The income statement is like a report card for a company's performance over a period. It answers the question, how much profit did the company make? The core idea is simple. You start with the money the company brought in, subtract all its costs, and what's left is the profit. Let's break down the key components. First up is revenue, also known as sales. This is the total amount of money a company generates from its primary operations, like selling products or services. It's the top line of the statement. Next, we subtract the cost of goods sold, or COGS. This is the direct cost of producing the goods or services the company sold. For a car manufacturer, it's the cost of the steel, tires, and labor to build the car. Revenue minus COGS gives us gross profit. This tells us how much money the company has left to cover its other expenses after paying for the direct costs of its products. Then we subtract operating expenses. These are the costs of running the business that aren't directly tied to production, like salaries for office staff, rent, marketing, and research and development. Gross profit minus operating expenses gives us operating income. This is a very important number as it shows the profit the company makes from its core business operations before accounting for interest or taxes. Finally, we subtract interest expense and taxes to arrive at net income, also known as the bottom line. This is the company's total profit for the period. It's the money that can be reinvested in the business or paid out to shareholders as dividends. So to recap, the income statement shows us the journey from a company's sales to its final profit. Now that we understand the income statement, let's look at some key metrics we can calculate from it to analyze a company's profitability. First is net profit margin. This tells us how much profit a company makes for every dollar of revenue. You calculate it by dividing net income by revenue and multiplying by 100 to get a percentage. For example, if a company has a 10% net profit margin, it means it keeps 10 cents of profit for every dollar it sells. A higher margin is generally better, as it indicates the company is efficient at controlling its costs. Next is earnings per share, or EPS. This is one of the most watched metrics in the stock market. It tells us how much of a company's profit is allocated to each outstanding share of its stock. You calculate it by dividing net income by the total number of shares outstanding. A higher EPS is generally a positive sign, as it means the company is generating more profit for its shareholders. Let's look at a real-world example. Here's a simplified income statement for Apple. In 2022, Apple had revenue of $394 billion and a net income of $99.8 billion. Let's calculate its net profit margin. We divide $99.8 billion by $394.3 billion and multiply by 100. That gives us a net profit margin of 25.3%. This is a very healthy margin, showing Apple is highly profitable. Now for EPS. We divide the net income of $99.8 billion by the 15.9 billion shares outstanding. This gives us an EPS of $6.29. This means for every share of Apple stock, the company earns $6.29 in profit. By calculating these metrics, we can see that Apple is a highly profitable company. But remember, 1 year's data isn't enough. We'd want to look at trends over several years to see if profitability is growing or shrinking. Next up is the balance sheet. While the income statement shows performance over time, the balance sheet is a snapshot of a company's financial position at a single moment. It's built on a fundamental accounting equation. Assets equals liabilities plus equity. This equation must always balance, hence the name balance sheet. Let's break down this equation. Assets are everything the company owns that has value. This includes cash, accounts receivable, money owed to the company, inventory, property, plant, and equipment. Liabilities are everything the company owes to others. This includes accounts payable, money the company owes to suppliers, short-term debt, and long-term debt. Equity, also known as shareholder equity, is the residual value. It's what's left over for the owners, the shareholders. After all, liabilities are paid off. It represents the shareholders' claim on the company's assets. So the equation tells us that a company's assets are financed either by borrowing money, liabilities, or by the owner's investment, equity. By analyzing the balance sheet, we can assess a company's financial health, its ability to pay its debts, and how it's financed. Let's look at some key metrics we can derive from the balance sheet to understand a company's financial strength. First is the current ratio. This measures a company's ability to pay off its short-term debts with its short-term assets. You calculate it by dividing current assets by current liabilities. A current ratio of 1.5 or 2 is generally considered healthy, meaning the company has $1.50 or $2 in current assets for every $1 in current liabilities. A ratio below 1 could signal trouble. Next is the debt-to-equity ratio. This tells us how much debt a company is using to finance its assets compared to the amount of equity. You calculate it by dividing total debt by shareholder equity. A high ratio means the company is relying heavily on debt, which can be risky, especially if interest rates rise or the company's earnings decline. A lower ratio is generally preferred, as it indicates a more conservative financial structure. Let's use our Apple example again. Here's a simplified balance sheet. In 2022, Apple had current assets of $135 billion and current liabilities of $154 billion. Let's calculate the current ratio. We divide $135 billion by $154 billion, which gives us a current ratio of 0.88. This is less than 1, which might seem concerning. However, for a company like Apple with very predictable cash flows, this isn't necessarily a red flag. It shows the importance of looking at the full picture. Now for the debt-to-equity ratio. We divide total debt of $120 billion by shareholder equity of $59 billion. This gives us a ratio of 2.03. This is relatively high, meaning Apple uses a good amount of debt. Again, for a stable company, this can be manageable, but it's something to be aware of. As you can see, the balance sheet gives us a different perspective on a company's financial health, focusing on its assets, debts, and ownership. The third and final financial statement we'll cover is the cash flow statement. This statement is often considered the most important because it tracks the actual cash moving in and out of a company. Remember, a company can show a profit on its income statement, but still be short on cash. This is because the income statement includes non-cash items, like depreciation. The cash flow statement cuts through that and shows us the real money. The statement is divided into 3 main sections. First is cash flow from operations. This is the cash generated from the company's normal business activities. A healthy, growing number here is a great sign, as it shows the company can fund itself from its own sales. Second is cash flow from investing. This shows the cash used for or generated from investments. A negative number here is often a good sign, as it means the company is investing in its future, like buying new equipment or acquiring other companies. Third is cash flow from financing. This shows the cash from debt and equity activities. A positive number could mean the company is taking on new debt or issuing new stock. A negative number could mean it's paying down debt or buying back its own shares. The most important thing to look for is strong, consistent, positive cash flow from operations. This is the lifeblood of any business. Now that we've covered the 3 financial statements, let's put it all together and talk about how to use this information to value a company. The goal of fundamental analysis is to estimate a company's intrinsic value. This is the true, underlying value of the business, based on its ability to generate future cash flows. There are many ways to estimate intrinsic value, but a common and intuitive method is the discounted cash flow, or DCF model. The DCF model is based on a simple principle. The value of a company today is the sum of all the cash it will generate in the future, discounted back to today's dollars. Why discounted? Because $1 today is worth more than $1 tomorrow. Let's visualize this. Imagine a company is a machine that spits out cash every year. The DCF model takes those future cash flows, like the cash flow from operations we saw earlier, and brings them back to the present. The sum of these present values is the company's intrinsic value. If our calculated intrinsic value is significantly higher than the company's current market price, it suggests the stock is undervalued and could be a good investment. This is the core idea behind value investing, buying $1 worth of assets for 50 cents. It's about finding bargains in the stock market. While the DCF model is powerful, it can be complex. A simpler way to compare companies is by using valuation multiples, like the price to earnings, or PE ratio. The PE ratio is one of the most widely used valuation metrics. It tells us how much investors are willing to pay for each dollar of a company's earnings. You calculate it by dividing the company's current stock price by its earnings per share, or EPS, which we learned about earlier. Let's use our Apple example again. Let's say Apple's stock price is $170 and its EPS is $6.29. We divide 170 by 6.29, which gives us a PE ratio of 27. What does a PE of 27 mean? It means investors are willing to pay $27 for every $1 of Apple's earnings. But is that high or low? The PE ratio is most useful for comparing a company to its competitors in the same industry, or to its own historical average. A company with a lower PE ratio than its peers might be considered undervalued. For example, if a competitor in the tech industry has a PE of 40, Apple's PE of 27 might look attractive. However, if Apple's historical average PE was 15, then 27 might be considered high. It's all about context. Beyond the numbers, there are other crucial factors to consider in fundamental analysis. These are often called qualitative factors. Qualitative factors are non-numerical aspects that can have a huge impact on a company's future success. They are just as important as the financial statements. First, let's talk about management. Who is running the company? Do they have a proven track record? Are they ethical? Do they have a clear vision for the future? Great management can turn a struggling company around, while poor management can ruin a great one. Second is the industry. Is the industry growing or shrinking? Is it highly competitive? Is it subject to rapid technological change? Investing in a growing industry with high barriers to entry can be a smart move. Third is competitive advantage, or what Warren Buffett calls a SAR moat. What makes this company special? Is it a strong brand like Coca-Cola? A patent like a pharmaceutical company? A network effect like Facebook? A cost advantage like Walmart? A strong moat protects a company's profits from competitors. Finally, we have products and services. Are they innovative? Do they solve a real problem for customers? Are they in high demand? A company with a portfolio of strong, in-demand products is well positioned for growth. Remember, investing is about the future. While financial statements tell us about the past, these qualitative factors help us predict what's to come. Let's bring it all together with a simple, step-by-step process for conducting your own fundamental analysis. Step 1 is to understand the business. Before you look at any numbers, ask yourself, what does this company do? How does it make money? Who are its customers and competitors? If you can't explain it simply, you probably don't understand it well enough to invest. Step 2 is to analyze the financial statements. Go to the company's investor relations page or the SEC EDGAR database. Look at the income statement, balance sheet, and cash flow statement for the last 5 to 10 years. Look for trends in revenue, profit, and cash flow. Step 3 is to calculate key metrics. Use the data from the financial statements to calculate metrics like net profit margin, EPS, current ratio, debt to equity, and PE ratio. Compare these to the company's history and its competitors. Step 4 is to assess the qualitative factors. Research the management team, the industry, and the company's competitive advantages. Read news articles, listen to earnings calls, and see what experts are saying. Step 5 is to estimate intrinsic value. Use a method like the DCF model or valuation multiples to arrive at your own estimate of what the company is truly worth. And finally, step 6 is to compare your intrinsic value to the market price. If your estimated intrinsic value is significantly higher than the current stock price, you may have found an undervalued investment opportunity. This difference is your margin of safety. This margin of safety is crucial. It's the buffer that protects you if your assumptions are wrong or if the market takes an unexpected turn. It's the difference between buying a house for $100,000 that you know is worth $150,000. Let's quickly recap what we've learned today. We've taken a deep dive into fundamental analysis, a powerful tool for understanding the real value of a company. We learned that fundamental analysis is about looking at a company's financial health, management, and industry to determine its intrinsic value. Our goal is to find undervalued stocks, where the intrinsic value is greater than the market price. We explored the 3 key financial statements: the income statement, which shows profitability, the balance sheet, which shows financial position, and the cash flow statement, which shows the actual cash flow. We also learned how to calculate and interpret key metrics like net profit margin, EPS, current ratio, debt to equity, and the PE ratio. And we discussed the importance of qualitative factors like management, industry, and competitive advantage. Remember, fundamental analysis is not about getting rich quick. It's about making informed, long-term investment decisions based on a company's true value. This is just the beginning of your journey. The more you practice analyzing companies, the better you'll become. Start with companies you know and understand. Read their financial reports, ask questions, and most importantly, keep learning. Thank you for watching. If you found this video helpful, please like and subscribe for more investing insights. Happy investing!